Hello, everybody. This is Jason Thornton coming to you live from Orlando, Florida, and I'm going to be recording this so that if you're listening to this at a later date, I hope you guys are all doing well. Today we are going to be going over one of the most important tools that we have in our agency, and this is a tool that we developed based on years of experience of doing in-home presentations, and this tool we call it the Pitchpad. Basically, what you're seeing on my screen right now is a picture of the document that we use, and we use a printing company to print these out in tablets that are 25 pages per tablet, or you can do 50 pages per tablet, but we typically do them in 25 pages just so they're light and easy to carry around in your briefcase or your computer bag, whatever it is that you do. And it is a 2-page document. This is the front page, and this is the page that we're going to use in order to do what we are going to call our discovery. Because the goal of this document is to help you discover what it is that your client actually needs for you to do. Some agents in the final expense market, or even in the mortgage protection market, just show up at the client's home and they just throw them a couple of quotes. But if you don't actually go through the process of discovering what it is that the client needs, then you're no better than them, than those other agents out there. And all you really are at that point is you're just an order taker. You're just waiting for somebody to come along, like on a grocery store shelf, and pull your item off the shelf, and you just happen to be the one lucky enough to make the sale. But if you truly want to be a professional in this industry, and you truly want to help people, you have to be more than an order taker. If you're just an order taker, you show up and give a quote and hope they say yes, that kind of sales process is only going to generate maybe 2 sales out of every 10 appointments, whereas this process that we're using here to discover why it's important that they're meeting with you, why do they need this coverage, why do they potentially need other coverages and other things that you might be able to help them with, that is going to make a big difference to the number of clients you're able to help, the number of sales that you're able to make, how effective that you are with that particular client. So let's go ahead and jump right into this. So this is the front page, the discovery process that we're going to go through in order to help the client. The second page of the document, which I will rotate it when we get to this page, but this is the back side of the page. So after I do the discovery, I tear the piece of paper off the tablet, I turn it over, and then I start going through their options. Now, you'll notice that around the perimeter of the page, there's a bunch of different statements, like there's 30-day free look, temporary insurance agreement, A-rated carriers, and then across the bottom it says children's policies, term to permanent conversions, income replacement, term life, and there's other things around the perimeter. Those things around the perimeter are there strategically because those are conversation starters. Sometimes because when I leave, I'm going to leave this document with the client, and sometimes these clients are going to read these things, and they may read the one in the upper left-hand corner that's vertical that says hiring full-time or part-time, because we're expanding our agency and we need help from some more people. And guess what? If they read that and they realize, man, these guys are good, they're hiring, they may end up deciding to come to work with us, and you may pick up an agent through that. So those words around the perimeter are there very strategically. But let's jump right into this because I don't want this recording to be too terribly long. And again, this is a new process. I've never done this before, but I am broadcasting this from my iPad and I'm up onto the screen. And so as I move the document around, you may see bits and pieces of it, so it'll be easier for you to zoom in on the specific area of the document that I'm working on. Now, this document is designed for being able to present to 2 people, because a lot of the clients that we meet with are husband and wife, but there are situations where you're meeting with only one person. Maybe you're meeting with someone who's 75 years old and their spouse has already passed away, or maybe they're single, or whatever the case might be. But the document is designed so that you can either do a presentation to one person or a presentation to 2 people. Now, that being said, if you want to be a professional in this business and you want to be successful in this business, if you determine that there are 2 people in the house, like a husband and a wife, and you've only got one of them in front of you, you probably need to rebook that appointment and come back when you can sit down with both of the decision makers in the house. Otherwise, all you are is an information person. You are not a salesperson. You can give information to one spouse, but the likelihood that you'll sell a policy if that other spouse is not present is extremely low. In this business, we call that a one-legged appointment. So if you happen to be sitting down with John and Mary is not there, reschedule that appointment and come back to another time. So let's just assume that we're sitting down with John and Mary. I'm going to blow this up so that we can see this, and I'm going to go ahead and start filling this in. Now, a lot of times the wording that you use when you're meeting with a client is very, very important when you in order to get cooperation from the client. And so what I mean by that is the reason why we designed this document as a notepad with 25 pages on it is because when you pull this document out of your computer bag, this Pitchpad, and you set it down on the table, I have not one time since I've used this document, not a single time have I had a client push back on me and say, what do you need all that information for? But if I just take the lead, which is on an 8.5 by 11 sheet of paper, and I turn it over and start asking all the same questions, I have had clients saying, well, I thought you were just here to talk to me about, final expense. How much is it going to be? Now, I actually designed this document from a process exactly like that I've been using for years, where I would take the lead, turn it over, and I would ask all of these questions just like this. I'd draw a big T across the page. I'd write John on the left. I'd write Mary on the right, or vice versa. And then I would start asking them all these questions. And probably 10% of the clients said, well, what do you need all that information for? Ever since we put that request for information down into this one-page document, zero pushback. Because it looks official, it seems like it's the process, and most people don't object when they believe that they're doing the process the way it's supposed to be done. The objections come when you are not necessarily doing something that's a duplicatable process such as this, and you're just basically scribbling stuff on the back of a lead card and you're asking for specific information. But everything that's on this document is being asked for a reason. So when I'm sitting down with a client, the first thing I'm going to do is I'm going to build rapport. And typically speaking, I'm going to take 10 to 15 minutes, sometimes longer, to build rapport with the client. And we've done some other videos on how to build rapport. But once you have that rapport built, and it's time to move on to this document, you've got a couple different options, and you have to use common sense. The best case scenario would be you move to the kitchen table and take care of the business there. But sometimes you're in a home that maybe the kitchen table's in shambles. I've been in homes where people have stuff stacked to the ceiling on their kitchen table. I've also been in homes where maybe you're sitting down with a single person and they never eat at the kitchen table, so they don't even have one. They eat at a tray at the recliner in the living room. The nice thing about this being a pad is it's got a hard cardboard backing, so you can set it on your lap and you could write directly on it. So it's not going to be a problem. But be aware that the best case scenario, move to the kitchen table. And once you move to the kitchen table, moving into this document is very, very simple. I just tell the client, I say, I'm going to ask you a couple quick questions so that I can figure out how I can help you. My goal is to help you, and I just want to make sure that we're doing the very best we can for you. So I start writing in some of the basic information that I already know. So I might write down that the person's name is John and that he's 66 years old. But on most of our leads, we're going to have an age, but not necessarily the date of birth. So at that point, I'm going to ask him for his date of birth. And maybe he says his date of birth is 10/9/19. I guess that would be 51. Then I'm going to start asking about his medications. Now, it's really important that you don't spend a lot of time on this particular area, because with someone who's got a lot of medications, you could really end up wasting 15 minutes of your appointment time on this one question. And the longer we take on these types of issues, the more likely we're going to end up losing the client. So I'm going to ask them some very simple questions like, have you ever had a heart attack, cancer, stroke, or any other major medical condition, Alzheimer's disease, HIV, you name it. And a lot of times they'll say, yeah, I had a heart attack. If they had a heart attack, I'm going to write it down, and I'm going to ask them when. So let's say he says we had a heart attack 3 years ago. Okay, great. Well, do you take any doctor-prescribed medications? Oh, yeah, I take a whole bunch of medications. Well, what do you take the medications for? Well, I take some heart medication, I take some diabetes medication, so on and so forth. Now, I'm not going to take a list of all those medicines if someone's on a bunch of medicines. My goal is to get the highlights so that I can determine whether or not they're going to qualify for a level benefit option or if it's going to be a guaranteed issue graded death benefit option. And once I hit the first thing that I know is going to turn it into a graded, I don't care anymore. The rest of the medications don't make any difference to me. So if they told me they had a heart attack 6 months ago, I know it's going to be graded. I don't need anything more in that category. My goal is to determine, to take just enough information that I've made my underwriting decision. Once I make that underwriting decision, I'm done with that section. So if he tells me, yeah, the biggest thing that's happened to me is a heart attack 3 years ago, and I'm diabetic, so I'm going to write down diabetic. Now, anytime I'm looking at a diabetic, I want to know, is it insulin or is it pills? And so he tells me he's on pills. I don't care about the name. I just want to know, is it pills or insulin? But when I do have a diabetic in front of me, I want to know, have you had any major complications from diabetes? Have you had an amputation? Do you have retinopathy? Do you have some kind of burning sensation in your feet and you're on some kind of neuropathy medication? And he'll say, no, no side effects. Great. Now that I've got that basic information, I'm getting a feel for where I can go as far as the product is concerned. Next question. Do you have any other life insurance? Most of the time, our clients are going to tell us that they do have some other kind of life insurance. Sometimes they'll say, yeah, I got a $1,000 policy with my bank that I get for free. Or maybe they've got a $20,000 policy through Mutual of Omaha. But I'm going to ask them about these other coverages. There's a lot of reasons why we need to know about their other coverages. Number one, if they just took out another policy a month ago, there's a good possibility we're going to be able to save them some money. And if we find that option in the home where they've already got a policy and we can save them money, or they bought a policy through some direct mail thing that they didn't meet with an agent, we want to see that policy, because I guarantee you that those are going to be the easiest sales that you make. Running into a client who maybe has a policy through Globe Life, or where every 5 years the premium is going to go up, or they just bought a policy through Lincoln Heritage, which is 20 to 30% cheaper than, more expensive than some of our insurance carriers. Or maybe they bought a $10,000 Mutual of Omaha policy where they signed up through the mail and they didn't realize that it's got a 2-year waiting period, what we would call a graded death benefit, and we can put them into a level benefit option. But if you don't ask the question about their existing life insurance, then you have no idea what they have, and because of that, you may give them a quote for $20,000 in coverage, and maybe they're like, well, I can't afford a premium for another $20,000. I've already got this other policy. That's what they're thinking in their head. They're not thinking in their head, oh, well, if you save me some money, I can cancel that other policy and move those premiums over here. But when you find other life insurance in the home, especially policies that they don't have an agent, such as Globe Life or some kind of a graded plan they purchased directly through the mail, those are like gold mine appointments. But you will never know to dig there if you don't ask this question. So this is extremely important to ask these questions. And if you don't know what to do with the answers, that's perfectly fine. Once you get to the end of the discovery process, you can call, you can put a note in-home help, and one of our top producers or managers will give you a call and be able to walk you through that. So let's move the page up and let's look at this. Third question, offsets. So we use the term offsets because it takes away the objection a lot of times. What is an offset? It's something that they already have that could offset the need for their final expenses or for their mortgage protection. So I'm going to ask them, do you have anything else that might offset these expenses when you pass away? The other reason why I want to know about these offsets right now is because I don't want to face them as an objection 10 minutes from now or 15 minutes from now when I'm actually giving them a quote. If they don't tell me, oh, I've got $50,000 in my 401k, and I give them a quote for $10,000 worth of life insurance, they may say, well, you know, I guess I don't really need it because I've got $50,000 in my 401k. And now I'm blindsided by that particular, you know, objection. Whereas if I know up front that they've got money in their 401k, I know up front that they've got money in their savings account, I can utilize that information to avoid the objection. So let's say they tell me, yeah, I've got a 401k and I've got $55,000 in it. I'm going to say, great, that's really fantastic. I'm going to tuck that information away because on top of that, if I come across something like this, I'm going to book another appointment to come out and see them and see if I can help them do a rollover that might potentially give them more safety, permanent income, long-term growth, all of those kinds of things. But I need to know that information first. So in this discovery process, this one question could make you an extra $50,000 this year. And let's say they tell me I've got no savings, I've got no cash value in my life insurance, I've got no other money, so the only thing I've got is my $55,000. Well, first thing I'm going to tell that client is, it's really great that you've got this $55,000 in your IRA, but here's the thing, when you pass away, it's going to take your family a considerable amount of time to get their hands on that $55,000 because an IRA is an individual retirement account, and individual means it's your name and your name alone. That means that asset is going to have to go through probate, which typically takes 6 months before your family is going to get their hands on it. Whereas with a final expense life insurance policy, generally speaking, the claims are paid in 3 to 7 business days. So they're going to get their hands on that money much more quickly. Next thing I want to know is who's your beneficiary going to be? Is it going to be your spouse, your children, your grandchildren? And let's say he says it's going to be Mary. That's his wife. And he's got 2 kids, a boy and a girl, and he's got 4 grandkids. Great. I want to get an idea of what the picture of his family looks like because I want to start talking to him in terms of what's going to happen to Mary, his beneficiary, when he passes away. So by knowing that information, now if he tells me it's his kids that's going to be the beneficiary, I want their names too. I want to talk about it. So when we start saying, when you pass away, this is what's going to happen to Mary, I don't have to use the word beneficiary anymore. I can use the person's first name. It brings so much more energy to the conversation. It brings much more emotion to the conversation. And life insurance, you think about it, this is one of the only purchases a person will make in their lifetime that they will probably not benefit from. That the entire benefit is for their loved one. So this is a sale that people make for someone that they love and care about, not for themselves. So you have to make sure that emotion becomes part of your sale. If not, you're not going to be selling a lot of life insurance. So let's talk about what is John doing for work. Well, John says, hey, I'm retired. Okay, he's retired. Do you have Social Security income, John? Yes, I do. How much is your Social Security? It's $1,800 a month. Do you have any disability income? Nope. Pensions? Yeah, I've got a small pension. It's $611 a month. Do you have any rental properties? No. Okay, great. So your total income is $2,411. Let's move over and talk about Mary. So we got Mary. She's the same age. Her birthday is around the same time. And she's healthy. No medications, no nothing. There we go. Her current life insurance situation. She's got a $10,000 policy with Mutual of Omaha. Great. Does she have any offsets? No, 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 no. No offsets. Her beneficiary. Primary beneficiary is John. She has the same 2 kids and 4 grandkids. So let's talk about her income. And I'm going through these things with the client very, very quickly. I'm just on an information gathering quest here at this point. She's not working. Her Social Security is about half of his. She makes about $900 a month. No disability, no pensions, no rental, so she's going to make $900 a month. Now, we've got this handy little box in the center of the page here that talks about their joint income. I'm going to add those two values together, and I'm going to come up with $3,311 because this portion of it is incredibly important in order to build that emotion. So I'm going to start asking John a few questions. John, let me ask you this. How long maybe I'll ask this question to Mary too. Mary, how long have you guys been married? And she's going to tell me, oh, we've been married for 20 years. Okay. I'm just going to write that here right in the middle, and I'm going to put a little heart around it. Now, why did I ask that question? The reason why I asked that question is because you need to understand what is going to happen to Mary when John dies. You need to understand what's going to happen to John when Mary dies. And most people have no idea what is going to happen. So, here's the way it works if you don't know. When someone dies, if they've been married for at least 10 years, which is why I asked the question, the person with the greater amount of Social Security, that Social Security will remain no matter which of them die. The lower Social Security is gone. So if Mary dies first, John gets to keep his $1,800 in Social Security, and Mary's Social Security is wiped away. It no longer exists. If John dies, Mary's Social Security is also wiped away, and John's Social Security will transfer over to her. That second question I'm going to ask him is because he told me he's got a pension. I'm going to say, John, does your pension have survivorship? The most common answer they give you is, I don't know. If they tell you, I don't know, the answer is no. They don't have survivorship. And I'm going to tell them that. I'm going to say, well, if you don't know, the answer is no. Here's the reason why. When you set up that pension, they gave you two options for the monthly income. A greater amount of income with no survivorship, or a lesser amount of income in 50% survivorship. That's the typical way pensions work. Very few pensions, maybe 1% of them will offer a 100% survivorship, but no matter what, it's going to be a reduced amount. So instead of $611, they would have probably said, well, it'll be $400, but then Mary will get $200 for when you pass away for the rest of your life. And most people opt out of having survivorship because it's a better deal for them to get life insurance. But if they don't know there's survivorship, then what we do know for almost certainty is there is no survivorship. So in this joint income box, I'm going to, at this point, I'm going to kill them off. And I'm going to do that theoretically, of course, but here's what I'm going to say. I'm going to say, John, let's figure out what your situation looks like. John, when you pass away, and I never use the word if you pass away. One thing we know in life is that the only things that are certain is death and taxes. So when they pass away, John, when you pass away, and then I'm going to start scribbling on here. I'm going to say your pension will be gone, Mary's Social Security will be gone, and she'll get to keep your Social Security. So when John passes away, the total income in the house is going to drop down to $1,800. When Mary passes away, the only thing lost is Mary's Social Security, so John's income will be $2,411. So let me ask you this, Mary. John died last week. You lost your Social Security, you lost his pension, your total household income went from $3,300 down to $1,800. What are you going to do? Are you going to stay in this house? Are you going to bring on a roommate? Are you going to live with other family? Tell me what that looks like. And usually they'll say, well, I'd probably go live with my kids, or maybe my kids will come live with me, something along those lines. Very few older ladies are going to say, I'm just going to live here all by myself. Okay, I'm going to ask John the exact same question. John, Mary died last week. Your income went from $3,300 down to $2,400. What are you going to do? Are you going to stay in the house? So on and so forth. No matter what their answer is, I'm just in an information gathering stage at this point. And I really want to know what that situation is going to look like, because that's really going to help me determine how to best help them. Now, even though I'm there to talk to them specifically about final expenses, I'm also going to try to determine whether or not there are other needs in the home. And if you're looking at this document and it looks a little bit different to you, because this is the Pitchpad version 2.0, and all of this information down here in the bottom left-hand corner about final expenses is something that's new to the page. But I am going to ask them about their mortgage as well in every single home, because I really want to know what the situation is. You know, one of the #1 causes of bankruptcy is being widowed. So many older ladies end up having to go through bankruptcy because their husband died, leaving them with debts like a mortgage. They can't manage to make the payments, and they end up going into bankruptcy for one reason or another. So I want to know whether or not they've got a mortgage. Now, the purchase and refinance box is specifically for a mortgage protection lead, but the rest of the information is valid. So I'm going to ask them, do you guys have a home mortgage? And they'll say, yeah, I've got a mortgage. We owe about $50,000. Oh, that's the wrong page, or $50,000. How much is the house worth? Well, it's worth $150,000. Well, the difference between those two values is how much the equity is. That's how much cash they would have if they sold the house tomorrow, paid off the loan. How much is your mortgage payment? Well, taxes and insurance is about $500. Why do I want to know that? Because I know that if John's income goes away and she's only left with $1,800 a month, and she's got a $500 mortgage payment and maybe a $300 car payment, it's going to be very difficult to make it on $1,800. So I'm looking for a greater need. If I can sit down with a client and give them a $5,000 final expense policy, or give them a $5,000 final expense policy that has or a $25,000 final expense policy, and show them how that money would make sense in their home, a lot of times people will opt to buy more coverage, especially if it's in the budget. So I want to know whether or not there are other needs. Now, in the next box here, I'm going to ask them about their final expenses. I'm going to say, what kind of funeral are you planning for yourself? And some people will tell you burial, some people will tell you cremation. Whatever it is, I'm going to ask them the next question. Have you ever planned a funeral for a loved one? Yes. Do you remember how much that costs? Well, if they tell you no, then I'm going to tell them, well, the average funeral for a cremation is somewhere between $2,000 and $5,000, and the average for a funeral is between $7,000 and $12,000. But most of the time people will tell you, yeah, I did a burial, and it was roughly $10,000. Sounds great. Now, the next question I'm going to ask them is about this $50,000 mortgage. How many years are remaining on that mortgage? And let's say they tell me, well, it's a 30-year mortgage, and we've had it for 20 years, so about 10 more years. Okay, so $50,000 is how much it is right now, and it'll be paid off in about 10 years. So this is the curve that mortgage is going to take from $50,000 down to $10,000. So I'm going to write in $50,000, 10 years. The next section here on mortgage payment protection is an idea about how we can help the transition from when John dies to when Mary has to start making those payments on her own. So I'm going to take this $500 monthly payment, and I'm going to put in 12 months, and that would be $6,000. 24 months, which is $12,000, and 36 months, which is $18,000. This is what we call mortgage payment protection. And when you're talking to somebody about final expenses and they have a mortgage, it's something that needs to be discussed, and give these people the option to make those adjustments in their budget. So now that I've gone through the discovery phase of the process, my mind is moving. I'm thinking about the different options. I'm thinking about, what it's going to take for them to just basically bury themselves, and what it's going to take to potentially give additional protection, such as burial plus 12 months of mortgage payment protection, or burial plus 24 months of mortgage payment protection. The other thing is based on their response, I'm going to determine whether or not I need to go down that avenue. So if I ask John, when Mary passes away, what's going to happen? He'll say, if he said something like, well, I think the $2,400 a month I have is enough. My mortgage is only $500. I don't think it's going to be a problem. if that's his response, I'm not even going to talk to him about this. But when I talk to Mary, she says, oh, man, because I'm going to lose this pension too, I'm not going to be able to make that mortgage payment. That pension of $611 pays that mortgage payment every month. I'm going to talk to her about getting additional coverage on him. So it's always based on the response. I'm trying to find the need, and I'm trying to fill it. That is what a good salesperson does. Discover the need and give them a solution. It isn't to necessarily shove an option down their throat that they don't need. You will not be able to keep policies on the books if you're writing policies that people don't need. So let's take a look at the back side of this document. So this page here is the page where I actually am going to give them the quotes. Now, I have some blank area down below, and a lot of times I use that area. I use it for answering questions because I'm going to leave this document with them in almost every situation when I leave the home. But under options 1, 2, and 3, this is where I'm going to actually give them the quotes based on what I uncovered on the first page. Now, if I'm going to do quotes for husband and wife, I'm going to draw an extra line right there, and I'm going to put John on the top, Mary on the bottom, and I'm going to start running the quotes. And it's really, really important when you're quoting people coverage that you target certain numbers in order to make sure that the probability that you're going to make a sale goes up. It also is really important to take into account the coverage that they already have in place. So as an example, we knew that Mary already had a $10,000 policy, but she's in really, really good health. So knowing how much that policy costs might really help me determine whether or not, I can go in a different direction. Because since she's in good health, she can qualify for products that would be what we would consider to be like a standard issue product, which means it's a better rate than a final expense product. But most of those standard issue permanent option products have like a $25,000 maximum or minimum face amount. So in this particular situation, I might give her a number of different quotes. But the things that I'm targeting specifically on this quoting sheet is I'm specifically targeting, I want to look for something that's roughly $80 a month. The reason why I want to quote something that's roughly $80 a month is because I know that if I can give them at least a quote in that range and then one that's cheaper and one that's more, I've put myself in the ballpark to being able to make a sale. Now, if my lowest quote is a $200 life insurance policy, I'm going to be getting, I want to think about it quite a bit. But based on the need in this particular situation, let's say Mary said, yes, if John died, I would have a really, really hard time making that mortgage payment. I'm going to show them some of these different options. Now, we know he's got this $55,000 401k that he hasn't done anything with. And we can take that into account and just potentially show him just the final expenses. So that's going to be my option number one, is I'm going to show him a $10,000 policy because they told me that's what it would probably take in order to bury him. And whatever that number quotes out to be, I know that it's going to probably be, just making a guess, it's probably going to be $70 a month. Then I'm going to show him option number 2, and this is just final expenses. And I'm going to write that down. Next option, I'm going to show him final expenses plus 12 months of coverage for his mortgage payment protection. And that is going to be roughly $16,000. And let's say that policy is roughly $110 a month. Then I'm going to show him final expenses plus 24 months. And we know that would be $22,000. And let's say that one's roughly $150 a month. I want to show that range. Now, with other people who don't have a mortgage need and they just say, well, I think it costs $10,000, I might show them a $7,000 policy, a $10,000 policy, and a $12,500 policy, or $5,000. Like I did a quote the other day for a lady yesterday. In fact, I wrote a policy yesterday. Smaller policy was a $2,000 policy for $15 a month, but I showed her $2,000, $5,000, and $10,000. But why did I show her $2,000? Well, she told me she already had most of her final expenses taken care of. She already owns the plot. She's already paid for the casket. She's already paid for the vault. The only thing they haven't done is, she knows that her family will have a, like some kind of a celebration of life, and she wanted some money available to that. But she told me, I really don't think it costs more than $2,000. And I said, great. So let's start with that. And I showed her 2, 5, and 10, and she opted for the 2. Mary, on the other hand, let's say she says, no, I'll be fine without, or John says, because this is coverage on the beneficiary. So John says, nope, I'll be fine, but I would like to get her final expenses covered. So in that situation, since she has no life insurance, or maybe she does have life insurance, I'm going to show her, let's say, $7,500, $10,000, and $12,500. But I'm going to show the range, and if you notice, I may not be showing the same thing to both people because the situation is different for those 2 people who are in the event that they pass away. You don't have to write the same amount of coverage on the spouse that you write on on the opposite person. It can be different amounts. But when we give them these quotes, if we just say, well, a $10,000 policy is for her because it's female is $70 a month, and a $7,500 is $55 a month, and a $12,500 policy is $90 a month. If we just give them, and I'm just making those numbers up, but if we just give them these numbers and we're done, we're not going to sell that much life insurance. We need to go over what this policy will do for them. We need to give them a rundown of it. So as an example, let's say I'm just going to give one example because every single story is going to be different. I'm going to reiterate that this policy, hey John, here's the policy that I believe that we need to protect, one of the options we need to protect Mary. When you die, Mary's going to be faced with this $10,000 expense for your final expenses. We want to make sure that that is covered. And the other portion of this one will cover the mortgage payment for an entire year. That way when you die, not only is your final expenses covered, she does not have to worry about the loss of income for an entire year. And John, here's the reason why that's so important. Humans, us, people, we are only equipped to deal with one crisis at a time. And when you pass away, your wife is going to be facing emotional crisis. We do not want her to be facing a financial crisis at the exact same time. And if you look up the statistics, there is the numbers are huge about how many people, both spouses, die within 30 to 90 days of each other. A husband will pass away, in 30 days his wife will pass away, or a husband will pass away, and 90 days later his wife will pass away. It happens with a huge number of people. And the reason why I believe that happens is because that stress of losing somebody and the stress of dealing with financial crisis, that double whammy is enough that the person passes away. And so you do not want to be, having your wife a year after you pass away filing for a Chapter 7 bankruptcy and having to go through, something like that because you didn't prepare and leave enough behind. Now, there are other times where maybe I might show them, and I'll write it down here, but just imagine this being up here. There might be other times where I might show them a $10,000 final expense policy with a $50,000 accidental death benefit product in order to cover the mortgage in case of an accidental death. We have that policy with Mutual of Omaha, and we have those policies with Foresters. So I may tailor the quote in a different way, and I might end up trying to write, a final expense policy to cover that, and maybe an accidental death policy to cover this. A lot of times I use the accidental death for specific situations like truck drivers, because a lot of times you might be meeting with someone who's 66 years old. They may still be working if they've got some kind of a dangerous occupation or something along those lines. Another type of client that I'm gonna tailor this particular one to would be people who are motorcycle drivers. You see a motorcycle out front, you see Harley stuff in the house, and you ask that question, are you a motorcycle driver? this policy is coming out of the bag every single time. So you're going to make those kinds of adjustments in the home based on the specific situation. And if you learn how to ask those questions on the first page, and you utilize that information, and you think about it, and you do the most important thing you can possibly do when you're sitting down with that client, which is you put yourself in the shoes of the beneficiary, you're going to have a great amount of success utilizing this tool and doing your in-home presentations. Now, we're a little bit over time, so I'm going to go ahead and end the recording and wrap this up. But I hope this is helpful.